Exchange rate, illusions, and structural reality. Why the Indian rupee depreciates while the Bangladeshi taka appears stable. Introduction. Misreading currency movements as economic strength. The comparison between the apparent stability of the Bangladeshi taka and the gradual depreciation of the Indian rupee reflects a more common analytical error, treating exchange rate behavior as a direct proxy for economic strength. Exchange rates are not moral verdicts on an economic's performance. They are outcomes of institutional design, capability, capital mobility, policy choices, and external pressures. The divergence between Bangladesh and India in currency behavior is not a story of one economy outperforming the other. It is a story of fundamentally different systems interacting with global markets under different rules. To understand this divergence, one must shift from surface level observations to structural analysis. The apparent stability of the taka is not necessarily a sign of resilience, and the depreciation of the rupee is not inherently a sign of weakness. Both are rational outcomes of deeper macroeconomic configurations. Exchange rate regimes, control versus adjustment. The first structural divide lies in exchange rate regimes. Bangladesh operates a tightly managed currency system where the central authority actively influences the value of the taka. The objective is stability, often defined politically as avoiding visible depreciation. In contrast, India operates a managed float where the exchange rate is allowed to adjust within a broad band determined by market forces, with intervention only to smooth volatility rather than fixed levels. The difference produces fundamentally different observable outcomes. In Bangladesh, the exchange rate becomes an administered price. In India, it remains a market clearing price. The consequence is that Bangladesh suppresses volatility through intervention, while India absorbs external shocks through currency movement. The former hides pressure, the latter reveals it. The role of central banks, price defense versus market smoothing. The behavior of central bank amplifies this divergence. Bangladesh Bank engages in direct and sustained intervention to maintain exchange rate stability. This involves selling foreign exchange reserves, restricting imports, administratively managing access to dollars. The exchange rate becomes a policy target. In contrast, the Reserve Bank of India doesn't defend a fixed level of the rupee. Instead, it allows depreciation when global conditions demand it, intervening primarily to prevent these orderly market conditions rather than to enforce a predetermined price. The rupee's movement is therefore an adaptive response to external conditions, not a failure of policy. The difference is critical. One system converts reserves into stability, the other converts flexibility into resilience. Capital account, exposure, integration versus insulation. A deeper layer of divergence emerges from capital account dynamics. India is deeply integrated into global financial markets. It receives large amounts of foreign portfolio investment and is therefore highly sensitive to global liquidity cycles. When interest rates rise in advanced economies, particularly in the United States, capital flows out of emerging markets, including India. This creates downward pressure on the rupee. Bangladesh, by contrast, maintains tighter capital controls and has limited exposure to volatile portfolio flows. Its financial system is less integrated into global capital markets. As a result, it experiences less immediate volatility from global financial shifts. However, this insulation is not an unambiguous advantage. Reduced exposure to global capital flows also implies reduced access to external financing and lower participation in global financial systems. Stability observed in Bangladesh is partly the result of reduced transmission of global shocks, not necessarily super not necessarily superior economic fundamentals. Trade, structure, and dollar demand, scale and comparison. The demand for foreign currency is shaped by trade structure. India, as a large and diversified economy, has massive import bill, particularly for energy, electronics, and capital goods. It also has significant external borrowing by corporations, which creates continuous demand for dollars. This structural demand exerts persistent pressure on the rupee. Bangladesh's economy is far more narrowly structured, with a heavy reliance on garment exports, while it also imports energy and other goods. It is periodically compressed imports through administrative controls, particularly during the time of stress. This reduces immediate pressure on the currency but introduces distortions elsewhere in the economy. The critical distinction is that India's dollar demand is largely market driven and continuous, while Bangladesh is partially oppressed through policy intervention. This suppression contributes to the appearance of stability but doesn't eliminate underlying pressure. Foreign exchange reserves, stock versus sustainability. At first glance, Bangladesh's foreign exchange reserves, often cited at around 30 billion, appear substantial. However, absolute numbers are analytically insufficient without context. The relevant metric is not the size of reserves in isolation, but the adequacy relative to import requirements, debt obligations, and capital outflows. Bangladesh's reserves provide a limited number of months of import cover, often hovering near the lower bound of what is considered safe. Indian reserves, by contrast, are significantly larger both in absolute terms and relative to its economic scale, providing a more substantial buffer against external shocks. Moreover, not all reserves are equally liquid or usable. Portions of Bangladesh's reserves may be tied to loans, swaps, or other obligations, reducing effective availability. India's reserves are generally perceived as more liquid and credible. The difference affects markets' confidence, which in turn influences currency stability. The cost of stability, reserve depletion, and market distortion. Maintaining a stable exchange rate in the face of external pressure requires continuous intervention. Bangladesh has at various points stored significant amounts of foreign currency to defend the Taka. The process converts reserves into exchange rate stability, but it is not sustainable indefinitely. The defense of a currency creates secondary effects. The importers may face restrictions or delays in accessing foreign currency. Multiple exchange rates may emerge, with official rates diverging from those in informal markets. These distortions signal underlying stress within the system. India avoids these distortions by allowing the exchange rate to adjust. Depreciation acts as a pressure release mechanism, reducing demand for imports and improving exports competitiveness. While this introduces visible volatility, it preserves systematic balance. Inflation, trade off, and policy constraints. Exchange rate policy is tightly linked to inflation dynamics. A stable currency can help contain imported inflation, particularly for commodities such as oil. However, maintaining stability through intervention can create shortages and distortions that generate inflation through other channels. Allowing depreciation as India does can increase import prices and contribute to inflation in the short term. However, it also enables external adjustments, preventing more severe imbalances from developing. The choice is not about inflation and stability, but about different types of adjustment. Bangladesh's approach delays adjustment by prioritizing nominal stability. India's approach accepts gradual adjustment to avoid more abrupt corrections. Parallel markets and credibility gaps. One of the clearest indicators of underlying pressure in a managed currency system is the emergence of parallel exchange rates. In Bangladesh, discrepancies between official and market rates have been observed, reflecting constrained access to foreign currency. Such discrepancies indicate that the official exchange rate doesn't fully reflect supply and demand conditions. Stability at the official level coexists with volatility in actual transactions. This undermines credibility and complicates economic planning. In India, the absence of significant In India, the absence of significant parallel market activity reflects the credibility of official rate as a true market price. The rupee may depreciate, but it does so transparently without creating multiple competing price systems. Global monetary conditions, external drivers of current movement. The global monetary environment plays a decisive role in currency behavior. Periods of tightening by major central banks, particularly the US Federal Reserve, tends to strengthen the dollar, weaken emerging market currencies. India, with its open capital account, is directly affected by these shifts. Bangladesh relative insulation reduces immediate volatility but doesn't eliminate the underlying impact. Instead, pressure accumulates within the system, manifesting in reserve depletion and administrative controls rather than the exchange rate movement. Thus, the rupee's depreciation is partly a reflection of global monetary conditions transmitting through open financial channels. The Taka stability reflects the suppression of those channels, not their absence. The temporal dimension, gradual adjustment versus delayed correction. The most critical distinctions between the two systems lies in the timing of adjustment. India's exchange rate regime allows for continuous incremental adjustments. The rupee moves gradually in response to changing conditions, distributing the impact over time. Bangladesh's regimes delay adjustment by maintaining a stable nominal rate. However, this creates the risk of sudden correction if pressure becomes unsustainable. When reserves decline or confidence erodes, the adjustment may occur abruptly rather than gradually. This temporal difference has significant implications for economic stability. Gradual adjustment is generally less disruptive than sudden devaluation, even if it appears less stable in the short term. Conclusion: stability as an illusion, flexibility as strategy. The divergence between the Indian rupee and the Bangladeshi taka is not a reflection of one economic superiority over the other. It is the outcome of different strategic choices in managing external pressures. Bangladesh prioritizes visible stability through intervention, accepting hidden costs in form of reserve depletion and market distortion. India prioritizes systematic balance through flexibility, accepting visible volatility as a price of resilience. The critical error is superficial analysis is the assumption that the stability equates to strength. In reality, stability can be engineered and volatility can be a sign of adaptive capacity. The rupee's depreciation reflects its role as a shock absorber in a global integrated system mechanism. The Taka's stability, on the other hand, reflects the suppression of market forces within a control framework. Over time, the sustainability of these approaches will be tested. Systems that allow for continuous adjustment tend to avoid catastrophic corrections. Systems that suppress adjustment may achieve temporary stability but risks more severe disruptions when prices can no longer be contained. The central question is not why one currency falls and other remains stable, but what mechanisms produce these outcomes. Exchange rates are not neutral indicators, they are engineered or allowed outcomes. The Indian rupee reflects a system that allows market forces to operate within a managed framework, while the Bangladeshi taka reflects a system where authorities actively suppress volatility. Stability in this context is not evidence of strength. It is often the result of intervention. The key objective of this analysis is to dismantle the illusion that a stable currency is inherently superior to show that flexibility, even when it manifests as depreciation, can represent a more resilient economic structure. The divergence begins with exchange rate regimes. Bangladesh operates a tightly managed system where the central bank plays a dominant role in determining the value of the currency. This system prioritizes nominal stability. India, by contrast, operates a managed float where the currency is influenced by market forces, with intervention limited to prevent extreme volatility. This structural difference means that Bangladesh suppresses currency movement while India allows the rupee to adjust to external conditions. The result is not that one economy is stronger than the other, but that one reveals pressure while the other conceals it. The behavior of central bank reinforces these regimes. Bangladesh Bank actively intervenes in foreign exchange markets to maintain a stable taka. This involves selling foreign currency reserves and controlling access to dollars. In contrast, the Reserve Bank of India doesn't defend a specific rupee level. It allows depreciation when global conditions demand it, intervenes only to prevent disorderly movements. The difference transforms the exchange rate into a rate of dependent price or a responsive variable. The former consumes reserves while the latter preserves them. India is deeply integrated into global financial markets. This integration exposes it to capital flow volatility. When global interest rates rise, particularly in the United States, capital tends to exit emerging markets, pricing downward pressure on the rupee. Bangladesh, with tighter capital controls, is less exposed to these flows. This reduces short term volatility but also limits access to global capital. The apparent stability of the taka is partly a function of insulation, not superiority. India's volatility is the cost of integration, while Bangladesh's stability is the result of restricted exposure. The structure of trade further differentiates the two economies. India's large and diversified economy generates substantial demand for foreign currency, particularly for energy and technology imports. This creates continuous pressure on the rupee. Bangladesh's imports driven Bangladesh's export driven model, heavily reliant on garments, generates foreign currency inflows but also relies on policy tools to compress imports during stress periods. This artificial suppression of demand reduces visible pressure on the taka but introduces inefficiencies. India's demand is market driven and persistent, while Bangladesh's is partially controlled. Foreign exchange reserves are often misinterpreted. Bangladesh's reserves, while appearing significant in isolation, must be evaluated relatively to its import needs and external obligations. Indian reserves are substantially larger both in absolute and in relation to its economic scale. More importantly, India maintains a high import cover ratio, providing a stronger buffer against external shocks. Bangladesh operates closer to minimum safety thresholds, meaning its reserves are more vulnerable to depletion under pressure. The critical insight is that reserves are meaningful only when contextualized within the broader economic structure. Maintaining a stable exchange rate is not costless. Bangladesh defends the Taka by selling foreign reserves, imposing restrictions on imports and dollar access. These actions create distortions within the economy. Business may struggle to obtain foreign currency, leading to delays and inefficiencies. The stability observed in official exchange rates masks underlying stress. India avoids these distortions by allowing the rupee to adjust. While this result is visible depreciation, it prevents the accumulation of hidden imbalances. One of the clearest indicators of stress in a controlled currency system is the emergence of parallel markets. In Bangladesh, discrepancies between official and informal exchange rates suggest that the official rate doesn't reflect true market conditions. This indicates a shortage of dollars and a lack of confidence in the official system. India doesn't exhibit significant parallel market activity. As its exchange rate is largely market determined, the presence of multiple exchange rates in Bangladesh is evidence that stability is being artificially maintained. Exchange rate policy involves trade off. A stable currency can help control imported inflation, particularly for essential goods like oil. However, maintaining this stability through intervention can lead to shortages and inefficiencies that generate inflation through other channels, allowing depreciation, as India does, increases import costs but facilitates adjustment in trade balances. The choice is not between inflation and stability, but between different forms of adjustments. Bangladesh prioritizes nominal stability while India prioritizes systematic balance. Global monetary conditions exert significant influence on emerging market currencies. When interest rates rise in advanced economies, capital flows towards those markets, strengthening the dollar, weakening emerging market currencies. India, with its open financial system, absorbs this shock through rupee depreciation. Bangladesh, with tighter control, suppresses the immediate impact. However, this suppression doesn't eliminate pressure. It merely redirects it into reserves and administrative controls. The rupee reflects global realities, while on the other hand, the Taka attempts to resist them. The timing of adjustment is a critical factor. India's exchange rate system allows for continuous incremental changes. This spreads the impact of external shocks over time, reducing the risk of abrupt disruptions. Bangladesh's system delays adjustment by maintaining a stable nominal rate. However, this creates the risk of a sudden, potentially severe correction if pressure becomes unsustainable. Gradual adjustment is often less disruptive than delayed correction, even if it appears less stable in the short term. The comparison between the Bangladeshi Taka and the Indian rupee reveals a fundamental truth about currency systems. Stability can be engineered through intervention, but it often becomes at a cost of hidden vulnerabilities. Volatility, while visible and often perceived negatively, can reflect a system's ability to adapt to changing conditions. Bangladesh's stability is the result of control and suppression, while India's depreciation is the result of flexibility and adjustment. Over time, the system that allows for continuous adaptation tends to prove more resilient than those that prioritize short term stability at the expense of long term balances.